Well, hello everyone. Cynthia Tomaine with Interactive Brokers, and thank you for joining today's session on portfolio risk control with Python and QuantConnect. Now, this afternoon, I'm very pleased to have Jared Broad, founder and CEO of QuantConnect, who's going to deliver today's presentation. Well, Jared, thank you for joining us. I'm going to go ahead and pass the controls over to you so that we can get underway here today. So, Jared, if you can accept the presenter role and share your desktop. Let's get started here. And thanks for joining us, Jared. Jared, I am not able to hear you speaking. Do you happen to have your phone muted?
Here we go. Thank you. Thank you, Cynthia. My pleasure. It's great to be here.
Oh, much better when we can hear you. All right. I'll let you take controls now. Thanks, Jared.
Perfect. Well, thank you, everybody, for joining. My name's Jared. I'm the founder and CEO of QuantConnect. Today, I wanted to do a sort of systematic approach to researching a few different types of risk controls that people commonly use in their portfolio. I'm a so firstly, I'm going to be telling you a little bit about QuantConnect. We are a website platform which enables you to build automated investment strategies. We aim to give you the powerful tools that you need so that you can build amazing algorithms. We take care of all the hard work, all of the piping, all the plumbing, all of the data management, and let you focus on just building your algorithm. In this webinar, I wanted to present a more systematic way of researching your output. People often have an idea and they go and they code it up, and when it doesn't work, they just try something else. And if you do that enough, you're going to find something that looks good, but it might actually not perform very well in live trading. So the algorithms that we're going to be exploring are for illustration. So we're not going to be using this to draw a widespread conclusion, but more as a mechanism for the flow for how you should be performing your research, perhaps. So we are going to start with a quick introduction to QuantConnect and how we can help you design and test your ideas. And then, in case you didn't attend the last webinar, we're going to go over a recap of what we call this algorithm development process. So it's a step-by-step methodology where you can start by quickly testing your ideas and then systematically bring them through to live trading. Once we've understood the right way to do this algorithm development, we're going to create our investigation thesis. So this is the foundation for how we're going to start our research. And then with that thesis, we'll develop a control. So it kind of feels a lot like a scientific study. If you've ever seen any scientific research papers, you can have benchmarks or control algorithms where you can form the foundation of your theory and then go up from that. Then we're going to test and research the new ideas, and we're going to test that on three common risk control methods. The first, most obvious one that people use is a trailing stop. When you have an asset in market, oftentimes people put a trailing stop. Sometimes they can buy an option for insurance, buying an option to hedge any downturns in the market. And then finally, a covered call. So this isn't strictly risk control, it's sort of a more active way of risk management. But we put it in here because it's fun. With QuantConnect, you can do a bunch of really cool things. So it's always fun to explore the different ideas. So firstly, QuantConnect's on a mission, really. We want to bring openness and free data and collaboration to the world of finance. We see ourselves just like Linux and the open source revolutionized the software industry, and the entire internet basically runs on Linux. We want to do the same for the financial community. We've got a large open source project called Lean, And you can use Lean to design and build your algorithms, and it's all free and available online. So you can pull it down and use it on your own servers if you'd like. If you're designing algorithms in QuantConnect, we have a Quant community where people design these algorithms and they can collaborate and work together. And we help them, number one, to build their algorithm, and then also we help them get funding when they need to. So today, QuantConnect is about 44,000 engineers, data scientists, programmers from all over the world. We have about half of the user base in the US, but then the rest is all over the world, and it's really exciting to work with people all over the place. We were founded in 2012, so it's been a few years now, and we open sourced a few years ago. But yeah, it's been fun. So the common thing for all of these quants is that they're all building algorithms. There's 40,000 engineers, so they're designing thousands and thousands of algorithms. And we see a lot of the mistakes that people make. So one thing that we see is the same mistakes over and over again, and we try and help people learn and not repeat those mistakes. For example, by more systemized research. On the QuantConnect platform, we support C#, Python, and F#, and people can use any of those languages. We have US equities, options, futures, data, so there's a wide range of data. Yeah. So behind the scenes, we combine the Lean open source algorithm technology, and then we put it with terabytes of equities, options, futures, forex, and crypto data. So we actually just added crypto trading to the platform, which has been really fun. It's been a fairly challenging project. And so now you can also backtest and design algorithms on crypto assets. And then we pair that with really powerful dedicated machines in the cloud that are overclocked and running really, really quickly so that you can do backtests as fast as possible. So it gives you a really robust platform for testing your ideas. And if you, again, if you want to pull down Lean, you can just go to GitHub and search for QuantConnect. It'll be one of the first things that shows up. When you start to develop an algorithm, the first thing that you should do is make sure that you do it in a systemized way. The point is just to save you time. If you do it in an unstructured way, you could go off down dead ends and explore ideas and test things which are just a waste of your time, or worse, they look very promising, but in reality you're just curve fitting. So there's a few structural things that we recommend people go through. So firstly, when you have an idea, to save yourself time backtesting it and coding it up, you can go to a research environment. And in the research environment, you can very quickly test your ideas. And it can be quick and dirty, and it doesn't need to be a perfect model of your idea, but you can test it and see how it performs. And then if it performs well in this theoretical, feedless research environment, that's when you can sort of move it to the next step. And that is basically taking your idea and coding it up in Python or C# and running a real backtest. When you run a real backtest in QuantConnect, we handle the accuracy modeling. So you don't need to worry about the fees or the slippage or the market depth of the asset. We handle all of that for you. And all the data is just sort of made available and presented to your algorithm. So it gives you a much more realistic picture of how the algorithm would have performed. And then in order to prevent overfitting, during your backtest phase, you should use as few variables as possible. Basically, there's a saying, I think it's, if you give me 5 variables, I can model the universe. And it's just saying that with 5 variables, you can make any line look good and fit any sort of problem that you've got. So try and do it without any variables, or use very common, standard industry standard variables. From there, once you've got an algorithm in QuantConnect, you can just go paper trading with the identical algorithm. You don't need to make any changes, so you can just deploy the same code to production. And in doing that, you can forward trade your algorithm on live data. And then finally, once your algorithm is doing well in paper trading, you can deploy it into production and sort of execute trades on your brokerage account. So yeah, this is kind of the algorithm process, and we recommend people go through this process to fast track the development. The first thing though is that you need to develop a hypothesis. So for the point of this webinar, we wanted to define our hypothesis as the market is completely efficient and any attempts at risk control are futile. So in science, you have a null hypothesis where you set out to disprove something. So we are setting out to disprove that hypothesis with trading stops and hedging. And so we can do that by comparing the performance of our new algorithms with some sort of benchmark algorithm. So yeah, keep that one in mind for the next few slides. This is the hypothesis, and we're going to be evaluating the performance of these new risk control algorithms. But half the problem is actually defining the measure for success. So just for the point of this webinar, we're going to define it as the Sharpe ratio, which is the risk-adjusted return. So it factors in the risks that you're taking, and then also the drawdown, so that you can look at how much drawdown your algorithm has using a control algorithm versus a trailing stops and option hedging. So in science, you call it a control, but in finance, you call it a benchmark. So we need to define the baseline performance so that we can judge whether or not risk control has any impact. So the baseline performance should ideally be as close as possible to the other algorithms. You don't want to have one control and then have another test algorithm which is has lots of different lines of code in it. So for the control, we've chosen that we're just going to make a long only MACD, and when we get a sell signal for the MACD, we're going to liquidate the portfolio, and it will just go flat, and it will just buy and go long. So then off that, we'll have two experiments. We'll have the long only MACD, and then we'll just add a trailing stop, and that'll be the only difference. Ideally, 90% of the code should be identical. And then similar for the other two experiments, we'll have the long only MACD, but instead of liquidating, we'll buy a put option to hedge the downturn. So yeah, so that can be our control. We've got this long only strategy, this long only MACD strategy, and then from there we can investigate these other options. So keep in mind, the actual performance of these isn't really important. We're trying to see the relative performance. So we're trying to see how the long only with trailing stop performs relative to the control. And so literally no effort's being given to make the curves look good. We just want to see how a trailing stop impacts the algorithm. So first, we do some exploratory research. So we have we've made up this notebook for you. Jing's been hacking away and made a MACD stop loss research notebook. And you can see here we've got the basic defines for creating a QuantConnect notebook. And then here has imported the IBM price history. So here we can just, with one line of code, we can just import the price history for IBM and then get the price into this array. We've taken a MACD function here, and we're just using the TALib, it's a technical analysis library, and passing in the data and calculating the EMA for the MACD. And then finally, we can develop a data frame and get the MACD signal. So using that, we just need to see and when the MACD is greater than the signal line, we'll go long, and then when it goes underneath the signal line, we can go flat. So we've plotted some signal lines here over a short period of time. This is just over the last year. And then Jen's defined this way that we can calculate the profit from the strategy. So assuming we go long and flat at different points, what would be the profit of the equity curve for the strategy? So then finally, we take the profit calculations, we take the MACD signals, and we develop a strategy equity curve for the different things that we're analyzing. And we can see here, according to this research, it looks like the MACD, the basic MACD signal itself, actually has a better equity curve than the stop loss strategy. So we need to understand this better and do some more research into this. So let's dig into the backtest. And then you can see here that there's a couple of links so that you can go and download the backtests that are associated with this research notebook. And just to make it more visual, to help visualize it, we've got the equity curve here for IBM, and then here's the trailing stop line. So for this algorithm, the trailing stop's actually defined as the lowest price in the last 30 days, the last 20 trading days, so the last month. And so as time goes on and the price is going up, we're moving up that trailing stop, and it gets triggered. So here we can see that after a month's gone by, you can see the price has gone up for the trailing stop, the dotted line here, and it's going to keep tracking the asset price up. And then you can see the MACD buy and sell signals here on the chart. So yeah, before I jump into the implementations, right? No, actually, let's go into the control implementation. So you can see here. So this is the code that we've coded up beforehand, so that you can just clone it and get started yourself. We have this algorithm that's been shared to the forums. So if you are interested, you can go to the QuantConnect forums and you can clone this algorithm and start hacking away at it yourself. So we've defined the start date, we've defined the cache, and we've added the SPY or IBM in the example that we're looking at as our asset, and then following a MACD on that asset. So we've got a few basic error controls here, so that if the market's not open, we don't really want to be doing any trading. And then finally, we come in here and we just say that when the MACD is ready, if we're not invested already, and the current line is greater than the signal line, then we just do a market order for 100 shares. And so then this is the entry strategy, and then to minimize the changes that we have in our algorithm, we've got a few predefined exit strategies here, which you can see just by uncommenting this part of the code. So the first one here is just the control. So this is if we're invested and the signal line is below the current value, then we liquidate. So that was going flat, as we mentioned. And then this one is the trailing stop. So we've got the current asset price, and if it drops below the historical minimum price for the last 30 days, then we liquidate. And then finally, this one is the option hedge. So if we're invested and the MACD value is less than the current signal value, then we buy a put. So instead of liquidating, we're going to continue holding, but we're just going to buy a put, which in theory should go up in value when the market's going down. So yeah, in that way, we can do this sort of testing with minimum changes to the algorithm itself, so that we can really compare the different the different performance of the strategies. So you can see this discussion here, managing risk with trailing stops. And to save you some time, we've actually gone and rerun these back tests, and you can see the code for the back test here. And so you can see the MACD signal. We got a MACD signal, and then it went flat. And we got another long signal, and then it went flat. So this is our control algorithm, and we've run that already. And we'll look at that performance in a second. Brian has asked, where can I get a sample copy of the Python program? If you go to the forum, the QuantConnect forum, so that's quantconnect.com/forum, and the discussion name is called Manage Risk with Trailing Stops and Predictive Options. So if you go and find that discussion post, I think I might be able to send it through. Cool. So Nunal has asked, how are the transaction costs captured? We have a system in QuantConnect where we have fee models and slippage models, and every time you place a trade, we model the cost of that trade. So in this case, it's Interactive Brokers, and we're modeling the Interactive Brokers costs of the trade. Dan has asked, how do you model the slippage for a trailing stop? It's a good question. The slippage is a built-in slippage model, but the times where the market's falling, the slippage model might not be perfect. It might not be as accurate as the real thing. But with QuantConnect, you can actually override the slippage models and create your own. So if you have a stock which is particularly volatile or has a very wide spread, you can then go and add your own slippage models to reflect that, to make it better. So I've already talked about this briefly, but this was the trailing stop hypothesis. So it's taking the lowest price in the last 30 days. So that's here in this case. So here we see the green buy signal from the MACD, and then it's placed the MACD position there, and then it's also recorded the trailing stop line. So we can go to this back test, and as I was showing before, the changes are fairly minimal. So you basically just uncomment out this piece of the code, and then you can run your own trailing stop backtest, and then the results will look like this. So here we can see the trailing stop backtest, and here's the MACD control study. So it's running about 52K, and the Sharpe ratio you can see in the statistics tab. Sharpe ratio here is 0.844. And if we go to the trailing stop one, you can see the statistics, and the Sharpe ratio is 0.615. So that confirms the theory that we had from the research environment. So with the research environment, we found that the trailing stop had worse performance, which I wouldn't, you might not think so. You might think that the trailing stop did better. And so this actually confirms that. So it's nice to have some confirmation that the research environment was indeed correct, that the stop loss strategy doesn't perform as well relative to the control study. So now that we've done one comparison to the control, let's do our next experiment. So what's the hypothesis for the option hedge strategy? So we're still going to use the MACD long-only entry point, but instead of liquidating when we get a sell signal, we're just going to buy the put. So when the MACD signal crosses below, we are buying a put. And in theory, when you buy puts, it should ensure this downtime. So from this moment all the way till this moment, you'll have insurance. The puts that we're buying in this case are actually month-long expirations, so we should have insurance for the month, and it'll be from the moment that we get that MACD sell signal. So I wonder how it performed. Before I go on to that, Nick has asked, what are the settings for the MACD? And it's a good question. Settings for MACD are a variable, and you should eliminate all variables as much as possible. So the settings that we chose for this MACD were actually just the stock settings that come with MACD. So it's 12, 26, and 9. So we didn't, basically as soon as you start touching those numbers, you're curve fitting. So if you're doing anything where you're fiddling with numbers and fiddling with the settings, then you know that it's you're going to be curve fitting and it's not real. So margin requirements for option combinations. Yeah, that's a good question. So Marcus asked, how do we model the margin requirements for option combinations? We've got some basic option margin modeling in QuantConnect, and it's not as great as it could be. We definitely know that. So there's sometimes where you do a straddle or something which reduces the margin that you need. IB will model it correctly, but we won't model it correctly in our back tests. So that's kind of a fairly specialized feature, and we will build it in, but for now you can just set your capital requirements to $1 million and then not have to worry about it. So yeah, this is the option hedge hypothesis. So we're buying the puts and ensuring the dip. So does it perform better? Who knows? Let's test our, where we go. Let's check the results. Let's see how it performs. So we can go back to the research, back to the forum post, and you can see here we've got the predictive put options research. We can open that back test, and we can see here that, as expected, the curve doesn't really go flat a lot like the control did. So the control had long periods where it was liquidated, as we'd expect, and the put option was much smoother because we're buying the put option to hedge these, and the put option itself has a value. So it sort of passes a sanity check, and then we can go and look at the code and verify here that we're buying a put, we're doing the control entry, and then we're buying the put to exit. And then let's check out the stats. So here we can see the Sharpe ratio has gone up to 1.1, drawdowns 0.38. So at first glance, this might actually be an improvement on the control. So if we go back to the control statistics, we can see here the drawdown was quite low. That's great. The Sharpe ratio is also quite low, though. That doesn't beat the benchmark. So this is interesting, and we are taking a look at a single asset over a limited time frame, and there's all sorts of problems with the research that we've done so far. So the reason why we started off with IBM was because IBM is pretty much range bound in this period of time. So from November to November 2015 to present day, IBM's been basically flat. It's gone down or gone straight across. So it's not like the S&P 500. So I'm sure, as all you guys know, the S&P 500 has been going straight up for the last few years. So one of the things is that the risk control and the strategies that you're testing are specific to what you're trading as well. So the fact that in this case the option put did better doesn't actually tell us much. It tells us it did better on IBM using this particular type of risk control mechanisms. So I think minimally we should do another test, which is the same experiments but on the S&P 500. And so for that we model it using the SPY index, which follows it very, very closely, so that we can test the effect of our risk control techniques on a strongly trending asset. So we can understand when our risk control techniques are going to do better or worse. So we're going to jump back to the research. Before I do that, we know the price of the put. We have option data. So Chris Ryder has asked, how do you know the price of the put? If you're assuming constant volatility, the Black-Scholes model is unrealistic. Yeah, no, that totally. We have data from Oprah back to 2010. So it's 40 terabytes of options data. That's very, very difficult to work with. But we've got all of the historical data, and you can, when you ask for an option in your algorithm, we're using the real prices on the market at the time. How do we determine the strike price? That's a good question. I think we should check that in the code. So here we have the control. So here we can see that it's buying the put. And you can see here, this is the buy put function. I hope you can see it. We get the option contract list for this symbol, which in this case is IBM, and we get it for on the current date. So all of the contracts which are available on the current date. So then we look out for the next expiry in days. So we find all of the contracts which are at least so many days out, and then we sort them, and then we are looking here. We're taking the contract where the price is less than the strike price. So it's the strike price which is closest to the current asset price, so that we can hedge the current price. So wherever we are. So, for example, if we're in a dip with the IBM price, it'll be buying the put at that moment in time. So the only premium that we'd be paying would be the time decay, in theory. So yeah, you can. All of this is online. You can go and pour through the code, and it's all in this forum post here, managing risk with trailing stops. So yeah, so as I was mentioning before, the doing the study on IBM is great. So we have something which isn't trending, so that means that if it does perform, it might be performing independent of the asset, versus if you're buying Apple or if you're buying Bitcoin, it's been going straight up, and you basically don't need to do anything to make money. So we used IBM as a way to find something which was losing money over that period. So if we were at all above zero in performance, there might be some sort of signal in the work that we were doing. So then that really, it would be nice to test this on the inverse case, one where the markets are strongly trending, and see whether or not the risk controls are equally as bad or equally as good, and then try and deduce some conclusions based on that. So here on the forum post again, we've got the SPY experiments. You can open the control, trailing stop, and the projected put options. So as expected, we've got the SPY control, and we've got all the long periods of flat here. And you can see in the code, we've got SPY, MACD, and then we're doing a simple MACD entry and exit, really nothing else to that. And then here, the benchmark Sharpe ratio that we're looking at is 0.944. So we use this as our control for the SPY MACD algorithm, and now we need to see how does the trailing stop perform. So this is the algorithm with trailing stop, and we can verify that by going into the code. We have here the entry conditions. So when the MACD is greater than current signal, we place a market order, and then here we have our trailing stop. So when the price is less than the minimum of the last 30 days, we liquidate. So yeah, as expected, this is the SPY, and it's doing the trailing stop, and the statistics are interesting. It's 1.39, and so that's quite a marked improvement on the SPY control. So as expected, when the market is strongly trending, a trailing stop risk control performs really well. So you can, I hope that's intuitive. You're having a better performance, and let's check the drawdown here too. The drawdown is actually higher, interesting. And then finally, we have the put strategy here. We can go into the statistics, and we can see the Sharpe ratio for the buying the hedge to put, buying the put to hedge is actually worse. So we have to ask ourselves, why might that be as well? So if you're familiar with options, backtesting options theory, in a strongly trending market, assuming the S&P 500 is going to keep going up, you paying for your insurance would actually count against you. So it kind of makes sense that by paying for the insurance and spending the extra money on the put, that your performance might be slightly worse. So we can see here in the summary table that we prepared, you can see the IBM control, trailing stop, hedge. I didn't actually get time to cover the covered calls today, but covered calls had a phenomenal performance. But yeah, that was because they're a more active strategy rather than a risk control technique. So I didn't include that in the discussion today. And then we did a measure of alpha here to try and get an idea of the signal above the index. And then in the same way, you can see here the option hedging does just better than control, but the trailing stop is a clear winner in a trending market. And then again here, the covered calls are performing really well, mostly because it's an active strategy. And I'm sure you've heard the saying, the best defense is offense. It's kind of the same. Running a covered call strategy in addition to the MACD is basically an offensive strategy. So again, keep in mind that this is all a theoretical example. So we're walking through a strongly trending asset and a range-bound asset to see the impact of different risk control techniques. And the idea is to try and give you a framework so that you can explore your own ideas and explore them in a systemized way. So, you know, one of the fun things to do might be now that you've got this, and maybe now you'll combine covered calls with option hedging and see how it performs relative to the control. Because now you know the individual contribution of each of these techniques. Now you can start to combine them in more intelligent ways and understand really what's going on. So I'll take some questions. I see here that you guys have been asking. Ferris asks about the option assignment and back tests. We have a model in Lean which looks to see whether the option is profitable. So if the option is in the green, then we would assign the options to you. So it's modeling the counterparty. so that we can pretend like the other person's there, and they would probably exercise the option if it was profitable for them to do it. So then we have some sort of random, there's a little bit of a random model as well, so that you can model people who aren't always behaving rationally. Yeah, there's basically everything in Lean and QuantConnect is pluggable. So if you have an idea or if you don't like the existing models that we provide, you can actually go and build your own models. So Matt White asked, how granular is your options backtesting data? We have options data down to the minute and only the minute. So for all our other assets, it's also tick, second, minute, hour, and day. But for options, just because of the sheer volume and the nightmare of managing the data, we just have minutes at this time, but we may add other resolutions over time. Amol's asked, is it possible to do gamma hedging while writing options? Maybe. We can look into it. And the platform's fairly flexible, so you will probably need to have a look around and see if it'll do what you need to do. Yeah. Sorry, I'm just scanning back over the questions. Matt asks, will we add Ruby to the platform? Unfortunately, we're just hitting off the most popular languages right now. And for algorithm development, C# and Python are very, very popular. Adding a new programming language is a lot of work. So we'll just, at the moment, we'll have to stick with the ones that we've got. Python's kind of a dynamic language, though. C# is a very rigorous typed language, and then F# is a functional language. So we hit all three of the kind of use cases for programmers. So Amol asks, can I discuss a little bit about adding custom data? I'm happy to. It's not, I didn't actually cover it in this presentation, but you can add any data you like to Lean. We treat data just as a time and a value. And so we synchronize all the data by time, and we can feed it into your algorithm. When you add custom data, you just need to tell us how to get it. So when we're doing a backtest or when we're doing live trading, where should we get the data from? And then how should we read it? Where is the time column? Where is the value column? And then after that, all of that data will then be piped into your algorithm. Most of the time it requires defining a class. So it's just about 10, 15 lines of code. You write a class, but most of the class has already been written for you. So you just need to change the URL of where you get the data from, and then you change the columns of the data so that you can tell QuantConnect how to parse it and how to read it. There's examples of that in QuantConnect.com and in the open source project. I think the best place for you to learn about that really is to go to those sources and learn about it there. Ingrid asks about the Visual Studio support. We have a plugin in the open source project where if you prefer, you can code in Visual Studio. So it installs into your Visual Studio, and then when you save a project or when you run a backtest, it saves those files to the website. And when you run a backtest, it runs a backtest on your on the cloud. So that's in theory part of the paid plans. In practice, we let people do that for free for now. So if you have Visual Studio, Ingrid, please go ahead and you can design your algorithms as you like. Awesome. All right, guys, thank you so much. It was my pleasure to speak to you today. If you've got any other questions, feel free to send them through to the support. Just write the email address here.
Well, Jared, I'd like to thank you very much for today's presentation and to remind everyone we have been recording today's content, and you'll all get a direct link to today's recorded playback soon after the session ends. So if you want to come back and review those concepts, simply watch your email later on today for those direct links. By the way, they'll also be posted on the Interactive Brokers website. Underneath the education menu, you'll find Traders University and a webinar section that's included there. And Brian saying, excellent, looking forward to reviewing the recording. Well, I'll get that out to you just as soon as I get it compiled and uploaded to our servers. So once again, thank you so much to Jared Broad of QuantConnect for today's presentation. Have a great day. Oh, by the way, I want to thank all of you for your participation as well. So everyone, have a great rest of your day, and we'll see you next time on the webinars. Thanks, everyone. You can all exit using the X at the upper right-hand corner of that control panel. Thanks once again. Have a good one.
Thank you, Cynthia.